Good morning, everybody. This is John Seville, and this is your executive summary for stock setups for Friday, the 27th of May. Just, of course, as we go into the long weekend for those in the United States. And, of course, let's have a quick review on what we said in the last executive summary. I talked about not wanting to react to the market because I had that knee-jerk response because we were right at resistance. Of course, yesterday we saw the market hold right at that resistance level. And, of course, very low volume, 3.85 billion yesterday. On the Wednesday, 3.23 billion yesterday. So volume cut off quite a fair bit, and we're probably likely to see another low volume day today. So of course, markets are closed Monday, so then that basically only leaves us with today and Tuesday until open range resets on the Wednesday. So the bearish pattern is still in play, but of course we've had the upward push from open range, and that is of course why open range is such a valuable strategy combined with the patterns and probabilities. So having a look at what positions I would look at for today's trading, there are three that I found quite interesting. The first is another long hedge. Of course, so the long hedges are great to have when you get upward ticks like this. You know, things like QIWI are looking very strong. That'll probably hit its target today. I may just sell half and update my stop loss just below 12 bucks to give it some room to possibly move further till the end open range finishes out. But QIWI looking really good, for example. So we do want to look at hedges because most of my money is in shorts, in puts. So when I see open range break positive, I want to take long trades to offset potential up movement in the market. So CLMT is the one that I liked from that basket. And having a look at CLMT, you'll see that we'll just have a quick look at the insiders here. We have had a fair bit of insider buying on CLMT just recently, and that's from various different directors. You can see here all coming in from May. Now the dollar figures aren't huge, but it is broad spread buying from lots of different people all around the same time, and it's the only buying that's really happened in quite a long time, as you can see up here on the chart. So it's an oil and gas play, and there's other positions I'm holding short in oil and gas. So again, it's a traditional hedge where oil and gas drops, my puts make me money. Oil and gas rallies, well, then hopefully this makes us money. And then obviously we're buying strong potential trades and shorting weak trades. So basically, if we have a look at CLMT, I would be looking at the July or August $4 calls. Now the July calls last traded at 25 cents, but I can't. There's no active bid and ask on that in my data currently, so I have to see what that opens at. But 25 cents are the July $4 calls. The August $4 calls last traded at 35 cents. So I'd basically be looking to see where you can get the best price on the options. But I'd be looking at July or August $4 calls. I'd be looking for an entry at the current prices, or looking to see if during the day you get a pullback to the support zone. So I'll go to the 15-minute chart. You'll see why that is. So if we look at the support zone, we can see we've got a trend line here. On the 15-minute chart, we've also had a pullback in the money flow. Now that's going to oscillate back and forth, so that's to be expected. But we've also got the buy signal on the directional movement indicator. So we may get lucky. You may get a pullback down to say 373, kind of right around. You see the moving average at 372. So a pullback to this area, 373, or that moving average. That would be where I would want to get in. You can see we've got a horizontal support sitting there at 369, and then of course we have the trend line beneath it. So I'd be looking at an entry of 374 or above. Now that means if it doesn't get down there, I'd still take it, but I wait to see if in the morning today it does get down there before triggering in. But that's basically what I look for. The stop loss I'd be looking at 342, and the target would be 350. Excuse me, target would be 527. So of course, if we get up, if we're picking up calls at 35 cents, and the stock gets up to 527, then that you can basically add another $1.20 onto the price. So that could potentially be a really good 300-400% move on the options. But again, it is high risk. Always when you're trading options, only invest what you can afford to lose. You don't need to be putting 10% of your portfolio into an option trade or 20% of your portfolio into an option trade. Just consider what you're willing to lose, because options can be great and make you a lot of money, but if you don't manage them properly, then you can have potentially big losses. So don't put yourself in a position that if things all go bad, then that's going to hurt you. So just a little bit of a word for the wise. Okay, so GDOT is my is the next one, and this is a short. Now these guys make the kind of Walmart branded prepaid credit cards, and as you can see in the chart here, we've got a nice sharp divergence in the money flow, and have a look at how the stocks kind of acted over this last few days. We went down on 1.34 million shares on Monday. We went down on about 5.5% on 2.35 million shares on Tuesday, then up on only 800,000 shares on Wednesday, and then contracting in the range, like that's basic price action we taught you. Price action contracts, we run straight into the moving average resistance overhead, and are up on only 375,000 shares on Thursday. That's volume is just going nowhere. So I like this one. I mean, they've been trying to vote the CEO off the board of directors and oust him from the company. The credit cards weren't working, and they've had to reimburse people money onto their cards because of the fact they couldn't use them to pay their bills and things. I mean, there's a bunch of stuff that's going on that just doesn't scream yay to me. So I mean, and I like the chart. So I look at GDOT. I'd be looking at the September $20 puts, which are currently $1.40. My target would be 1967 is my first target, but my second target, which I think it should easily hit, is 1767, and I would use a stop loss of $22.77. And having a look at those, if you just come with me over here, you'll see that the September puts, the ones that we just talked about, traded quite a fair bit of contracts yesterday. 795 contracts sold with only 855 open interest. So that's a big chunk that's just gone straight there. Now you can also see that there's a fair bit of volume on the calls as well. $20 calls being written. But yeah, I like the put contract there. If you wanted to go a little bit, obviously it's safer and more in the money, the 2250s are also good. I think at $2.60. In fact, you've got a little bit less implied volatility there. So, even the 2250s would be fine as well. Okay, so then the next one, or last one, is ROP, Industrial Machinery, Tech. Now this is a bit based off, this is a trade that I liked based on the fact that the sharp money flow divergence, the fact that it hasn't participated in the market rally over these last few days, it's in fact gone down, and then looking at the weekly chart, it appears to be in a head and shoulders pattern. And so that gives us a measurement here of going from 190 down to 160. And then we look at the potential for that to drop further. That looks like a drop all the way down to potentially 125, 130. That could be a really awesome play. It's a strong company, as you can see over the history of its chart. It's just kept going up. But remember that, I mean, where this stock is at very high levels, and what goes up eventually will have some oscillation down, and this is a great pattern, I think. Let's have a quick look at the Fibonacci retracement from this level of support up to the top of the trade zone here. So you can see the 50% Fibonacci comes right into play around 130 there. So and that's pretty close to where our trend line, of course, depending on where it breaks, is going to mean how far up that trend line expands from. So let's say we got a break here around mid-June that would take us to, then we would be looking at a target of 130 anyway. So the 50% Fibonacci aligns then therefore with the target. So I'd be looking at the November 150 puts, which are currently $3.70. And the August 170 puts, which are currently 620. And that would be to play these two different targets. So on the November 150 puts, I'd be looking at a target of $133. On the August 170 puts, I would be looking at a target of 161.33, which is right as it hits the bottom of that neckline. So basically, you've got two different contracts to trade two different targets. Um, okay, so with this one, in terms of a stop loss criteria, I would be looking. I'd be looking at stop criteria above the high of this candle, which would be, we're looking at 183, so I'd be looking at 180, 184.87 as a stop loss criteria. And that gives us, I mean, we're looking at yeah, like a pretty decent sized drop if we can really really get down to that second target. We'll just go back to the daily chart and have a look if we can make that even a little bit more. Yeah, so as soon as we get down, we can start adjusting that stop loss beneath this kind of support level. This would be my most likely area that I'd change the stop to. We'd kind of be looking at this. You can see these two sharp levels of reversal there and there. So I'd be looking at then moving that stop losses down as quickly as possible down to this kind of 175 zone. Okay, so that's it for the executive summary. If you're not a fully fledged member of the trading room, then you can and these executive summaries, you can give it a try for only $9. That's $9, and you can sign up at acornwealthcorp.com/gold to see what it's all about. And I look forward to seeing you in the next summary. Hopefully, we've had some big movement by then, and have a wonderful weekend. Take care.